The gold to silver ratio stood at 15, one for most of recorded human history. Today, it fluctuates between 70, 1 and 90, 1. This means silver, relative to gold, is trading at less than 1/5 of its historical purchasing power. But in 2025, something shifted. Silver gained 36%, while gold rose 27%. For the first time in decades, industrial metal momentum exceeded monetary metal momentum. This isn't a market anomaly. This is the price system revealing what money actually is when the definition becomes contested. You've been told precious metals are relics, that they belong to survivalists and conspiracy theorists, that modern economies move past commodity money into sophisticated credit systems backed by central banks and digital infrastructure. But if that's true, why did global central banks add more gold to their reserves in the past 3 years than in any period since the collapse of Bretton Woods? Why did silver prices surge while industrial production remained flat? Why does the metal used in solar panels, electronics, and medical devices suddenly behave like the metal locked in vaults? Most people believe precious metals derive value from their physical properties: rarity, durability, conductivity. This is partially true. It works during growth. It works when credit expands smoothly and supply chains function predictably. But it fails during transition. It fails when the relationship between claims and reality begins to stretch. It fails when currencies lose definition and trust becomes expensive. Gold has always been the reserve. Silver has always been the transaction. Governments stockpile gold. Industries consume silver. This worked for thousands of years because the ratio remained stable. The ratio was not arbitrary. It reflected how much silver circulated relative to how much gold was hoarded. It reflected velocity against storage. But when silver becomes scarce, not because mines close, but because industrial demand absorbs supply faster than recycling can return it, the ratio compresses. When gold becomes abundant, not because new deposits appear, but because central banks print claims against reserves they don't physically expand, the ratio stretches. The current divergence tells you something about both. Between 1792 and 1873, the United States legally fixed the gold to silver ratio at 15, 1. 1 ounce of gold could be exchanged for 15 ounces of silver by law. This was not symbolic. It was functional. Silver coins circulated. Gold coins represented concentrated wealth. The ratio allowed conversion between scales of transaction. But by 1873, the U.S. ended bimetallic standard and demonetized silver through the Coinage Act. Silver crashed. The ratio expanded to 30, 1 within decades. Miners revolted. Farmers who borrowed in gold-backed dollars and sold crops for silver-backed currency faced debt they couldn't repay. The structure didn't fail because silver lost utility. It failed because the government changed which metal counted as money. Between 206 BCE and 220 CE, Han Dynasty China operated a bimetallic system tying copper coinage to grain reserves and silver ingots to imperial taxation. The ratio between copper and silver fluctuated based on harvest cycles and military spending. When the empire expanded westward, silver flowed in from trade with Persia and Rome. The government couldn't issue copper fast enough to match silver inflows. Merchants hoarded silver. Copper depreciated. By the end of the dynasty, inflation in copper currency eroded purchasing power while silver retained value. The structure did not change. Only the names did. Between 1870 and 1900, the German Empire and most of Europe transitioned from silver to gold standards. Silver flooded global markets as nations liquidated reserves. India, which had used silver rupees for centuries, saw its currency collapse against gold-backed British pounds. Indian farmers borrowed in rupees, but exported goods priced in gold. Their debt burdens doubled in real terms. The British Empire extracted wealth not through conquest, but through monetary structure. The structure did not change. Only the names did. The pattern repeats. A dual metal system allows transactions at multiple scales. One metal circulates. One metal anchors. Trade and war shift supply. Governments adjust which metal defines the unit of account. Those holding the demonetized metal lose purchasing power. Those holding the monetized metal gain it. The transfer happens without confiscation. It happens through ratio adjustment. This is not a mistake. This is not accidental. This is how monetary systems manage imbalances when credit structures become unstable. Changing the ratio changes who benefits from stored value without changing the physical quantity of metal. Today, silver is used in photovoltaic cells, semiconductors, medical devices, and electrical contacts. Global industrial demand consumes roughly 550 million ounces annually. Mine production supplies approximately 850 million ounces. The difference comes from recycling and above-ground stocks. But recycling rates remain below 30%. Most silver, once embedded in electronics, is not recovered. It oxidizes in landfills. It becomes uneconomical to extract. Meanwhile, new applications expand faster than substitutes develop. Electric vehicle charging infrastructure requires silver. 5G networks require silver. AI data centers require silver. The industrial appetite is accelerating. Gold production is roughly 3,500 tons per year. Approximately 90% of mined gold remains in circulation. It sits in vaults, jewelry, or coins. It doesn't oxidize. It doesn't degrade. It doesn't disappear into infrastructure. Gold is reused infinitely. Silver is consumed finitely. This creates opposing trajectories. Gold supply grows slowly, but accumulates. Silver supply grows slowly, but depletes. Yet silver is priced as an industrial commodity, not a monetary one. Futures markets tie its value to manufacturing demand forecasts, not store of value premiums. Gold is priced as a monetary asset, not an industrial one. This distinction is arbitrary. It exists because financial systems define it this way. When industrial demand spikes and monetary demand rises simultaneously, silver pricing structure breaks. The divergence in 2025 signals the beginning of that break. You don't see it because the price is quoted in dollars. The dollar remains the unit of account. When silver rises 36% in dollar terms, you interpret it as silver becoming more expensive. But it's equally accurate to say the dollar is losing purchasing power against silver faster than against gold. The mechanism is invisible because the reference point itself is moving. When both metals rise, but one rises faster, the message is not about the metals. It's about the measuring stick. It doesn't feel dramatic because the change is incremental. Silver moved from $23 to $31 per ounce. Gold moved from $2,070 to $2,630. These feel like market fluctuations, but the ratio shifted from 1 to 85. 1. That's a 5.5% compression in a single year. Across history, ratio compression of this speed has preceded monetary transitions. In 1878, the ratio compressed from 1 to 1 before stabilizing. In 1919, it compressed from 1 to 1 during post-war hyperinflation. In 1979, it compressed from 1 to 1 during dollar crisis. It works quietly. Who benefits from silver's divergence depends on position, not prediction. Miners benefit from rising prices if costs remain stable. Manufacturers suffer margin compression unless they pass costs forward. Investors holding physical silver gain purchasing power. Governments holding gold reserves see relative stability, but not outperformance. Industrial consumers holding inventory locked in forward contracts avoid immediate pain, but face higher costs at renewal. Speculators in futures markets profit from volatility, but carry rollover risk. The largest above-ground silver stockpiles exist in India, China, and the United States. India holds silver through jewelry and religious artifacts. China holds it through industrial reserves and solar manufacturing pipelines. The U.S. holds it through private investment vehicles and mining output. None of these holders are coordinating, but all are responding to the same structural signal. Claims against future supply exceed probable delivery. Industrial users cannot secure multi-year contracts at stable prices. Refiners cannot source enough recycled material. Primary production cannot scale fast enough to meet projected demand. Gold's beneficiaries are clearer. Central banks in China, Russia, Poland, Singapore, and India accumulated over 1,000 tons annually between 2022 and 2024. This is not portfolio diversification. This is a positional shift. These nations are reducing dollar-denominated reserves and increasing gold reserves. They are not expecting gold to appreciate. They are expecting the dollar's purchasing power to decline. They are preparing for a system where settlement requires asset-backed transfers, not credit-backed promises. Gold becomes the anchor. Silver becomes the industrial bottleneck. This does not require coordination. This works automatically. Participation is optional only for those with excess capital. If you hold neither metal, you participate passively. Your currency holdings decline in purchasing power against both. If you hold only gold, you preserve wealth but forego industrial upside. If you hold only silver, you capture volatility but accept storage costs and liquidity constraints. The system benefits those who can hold both and wait. Why does this pattern continue? Because stopping it requires admitting the underlying claim structure is unsustainable. The global economy operates on credit expansion. Credit expands when confidence in future repayment remains high. Confidence remains high when currencies retain purchasing power. Currencies retain purchasing power when supply growth matches economic output growth. But output growth has slowed while money supply growth has accelerated. The gap is filled by debt. Debt is a claim on future production. When future production cannot meet claims, currencies devalue. Metals remonetize not because they are chosen, but because they are what's left when credit contracts. If central banks stopped accumulating gold, markets would interpret this as confidence in fiat stability. Prices would stabilize. The divergence would narrow. But central banks cannot stop without signaling distress. If they stopped, private markets would accelerate purchases, assuming institutional knowledge of impending crisis. The act of stopping creates the crisis it seeks to avoid. So accumulation continues. The same applies to industrial silver demand. If manufacturers stopped securing supply, it would signal reduced economic activity. Reduced activity would lower metal prices temporarily, but confirm recessionary fears. So they continue securing contracts even at elevated prices. The system is continued because halting reveals the imbalance. Policymakers face the same bind. Raising interest rates to defend currency value increases debt service costs. Governments, corporations, and households cannot sustain higher rates without default or austerity. Lowering rates to prevent default accelerates currency depreciation and drives capital into hard assets. Both options are destructive. Delay becomes policy. Metals reflect this. Their prices rise not because of sudden demand, but because the cost of holding claims against depreciating currency exceeds the cost of holding physical assets. This system has always ended the same way. The timeline varies depending on how much trust can be extended, how much debt can be absorbed, and how long populations accept declining purchasing power without demanding alternatives. But the outcome does not vary. At some point, the ratio between claims and reality becomes unignorable. At some point, industrial consumers cannot secure supply without bidding prices beyond economic viability. At some point, currency holders realize their digits represent less than they assumed. The transition is not sudden. It is a compression. It happens in stages, first gradually, then faster. The 2025 divergence between silver and gold is not a prediction. It is a measurement. It tells you industrial demand is colliding with monetary uncertainty. It tells you the old ratio is dissolving. It tells you the system is pricing a future where both metals matter again. but for different reasons. Gold because it anchors, silver because it enables. The distance between those two functions is narrowing. The system doesn't need to be fair to function. It only needs to continue pricing claims against reality. And when reality becomes more expensive than claims, the metals reflect it first.